Hey friends, welcome back. I'm super excited because today we're diving into something exciting. How a 20-year-old should start investing. Starting to invest at 20 years old is an excellent decision. Time is your biggest asset due to the power of compounding. Here's a comprehensive guide. Set clear financial goals. Before you invest, know what you're investing for. Are you saving for a down payment on a house, retirement, a large purchase, or general wealth building? Your goals will influence your investment strategy and timeline. Create a budget and emergency fund. Budget, understand where your money is going. Create a monthly spending plan to identify areas where you can save. Popular budgeting methods include the 50-30-20th rule, 50% for needs, 30% for wants, 20% for savings and debt repayment. Emergency fund. Prioritize building an emergency fund of 3 to 6 months worth of living expenses in a high-yield savings account. This will prevent you from having to sell investments at a loss. If an unexpected expense arises, prioritize high-interest debt. If you have high-interest debt like credit card debt, focus on paying that off first. The interest you save can often be higher than the returns you'd get from investing. Take advantage of employer-sponsored retirement plans like 401k. Employer match. If your employer offers a 401k match, contribute at least enough to get the full match. This is essentially free money and a guaranteed return on your investment. Tax advantages. These accounts offer tax benefits, either pre-tax contributions with tax-deferred growth in a traditional 401k or tax-free withdrawals in retirement with a Roth 401k. Open an individual retirement account. IRA. Roth IRA. For most 20-year-olds, a Roth IRA is highly recommended. Contribute after-tax money, and your qualified withdrawals in retirement are tax-free. This is beneficial if you expect to be in a higher tax bracket in the future. Traditional IRA contributions might be tax-deductible, and your money grows tax-deferred until withdrawal in retirement. Consider a brokerage account for non-retirement goals. If you've VA maxed out your retirement accounts or have other long-term goals like a down payment on a house in 5 to 10 years, open a taxable brokerage account. Choose your investments, focus on diversification and long-term growth, index funds, and ETFs. These are excellent choices for beginners. They provide broad diversification across many companies, e.g. On S&P 500 Index Fund, invests in the 500 largest U.S. companies at a low cost. 11. This simplifies investing and reduces risk compared to picking individual stocks. Stocks with caution. While you have a long time horizon and can afford more risk, avoid trying to beat the market by picking individual stocks unless you're willing to do significant research and understand the risks involved. Bonds. At 20, with a long time horizon, your portfolio should generally be heavily weighted towards stocks for growth. A small percentage in bonds can provide some stability, but their primary role for a young investor is limited. Automate your investments. Set up automatic transfers from your checking account to your investment accounts. This pays yourself first and ensures consistent investing. Increase contributions over time. As your income grows with raises or promotions, increase the percentage you're investing. Educate yourself. Continuously learn about personal finance and investing. The more you understand, the more confident you'll be in your decisions. How much percentage of salary to invest? The general guideline for a 20-year-old is to aim for 15% to 20% of your gross pre-tax income. This includes any employer match to your 401k. Start small if necessary. Even if you can only start with 5% or 10%, it's crucial to begin. The earlier you start, the more time compounding has to work its magic. Increase gradually. If you can't hit 15 to 20% immediately, aim to increase your contribution by 1% each year or whenever you get a raise. Sample investment plan for a 20-year-old. Here's a hypothetical plan. Assuming you have a stable income and have established your emergency fund. Goal: long-term wealth building and retirement. Percentage of salary. Start with 15%, including employer match. Aim to increase to 20% within a few years. Investment allocation: aggressive for long-term growth. 80 to 90% stocks given sample below. Index funds, ETFs, E, X, E, G, VOOS, PY4S, S&P 500. These provide diversification across many companies and sectors. Total stock market index funds, ETFs, for example VTI or ITOT, for even broader exposure to the U.S. stock market. BRKB or International Stock Index Funds, ETFs, for example VXUS, to diversify globally. 10 to 20% bonds, total bond market index funds, ETFs, for example BND or a GG account prioritization, first preference 401k up to employer match. This is free money. Next priority Roth IRA, max out annual contribution, tax-free growth and withdrawals in retirement are incredibly valuable for young investors. 401k beyond employer match, it's up to annual maximum. Continue contributing to your 401,000 if you have more to invest after maxing your Roth IRA and taxable brokerage account. For any additional savings beyond retirement accounts, check out this example. With a $40,000 salary and saving 15%. Annual investment, $40,000 asterisk 0.15 equals $6,000. Monthly investment, $6,000 12 equals $500 if your employer offers a 3% 401k match. You contribute 3% to your 401k, $1,200 annually, and your employer adds another 3%, $1,200. Check out my video on a 3-fund ETF portfolio with 10 years of performance. Key principles for a 20-year-old investor. Start early. This is the single most important piece of advice. Be consistent. Invest regularly, regardless of market fluctuations. This is called dollar cost averaging. Diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes and geographies. Stay invested. Resist the urge to panic sell during market downturns. History shows that markets tend to recover over the long term. Keep fees low. Choose low-cost index funds or ETFs. High fees can significantly erode your returns over time. 19. Review annually. Once a year, review your portfolio to ensure it still aligns with your goals and risk tolerance. Might rebalance your asset allocation as you get older, or your goals change. Starting early and staying focused can set a 20-year-old up for financial success. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.